Hello, I'm Munffett, and it's great to have you with me. As always, our goal here is simple, to cut through all the day-to-day noise and really focus on the fundamental shifts that are going to impact our strategy for the long haul. Okay, before we get into the thick of it, just a quick but important disclaimer. Everything we discuss today is purely for informational purposes. It is not investment advice. You should always consult with a qualified professional before making any financial decisions. So here's what's on the docket today. We'll start with a real quick portfolio update. Then we'll do our deep dive on General Electric and its margin story. After that, we'll unpack Moody's and its position in this new age of AI. And we'll wrap things up with a quick market note on LVMH that I think illustrates a really important lesson. All right, let's get right to it. First up is our weekly portfolio update, and the theme for this week really was just discipline, holding a steady course and not getting distracted by all the noise. And it's a simple one. We made no changes to the portfolio this week. You know, there's always some choppiness in the market, but frankly, we saw nothing that changes our fundamental thesis on any of our holdings. So, no reason to act. We feel good about where we're positioned. Okay, now for our first big topic, a deep dive into General Electric. We're going to look past the day-to-day headlines and really get into the nuts and bolts of the profit engine here, especially in that aerospace division.
And that really gets us to the key question, doesn't it? For a company like GE, with so much changing in the aerospace industry, are the margins of the past really any guide for the future? Frankly, I think there's a good chance the market is getting this one wrong.
Okay, so to really get GE's profitability, you have to understand their service contracts. It basically boils down to two types. First, you've got what they call long-term service agreements, or LTSAs. Think of this as an all-you-can-eat plan. The airline pays a fixed fee for every hour the engine is in the air. It's steady income for GE, but GE is on the hook for the repair costs. Now, the second type, and this is the important one, is time and material, TNM. This is more of a pay-as-you-go model. GE bills for parts and labor when the work is done. For GE, this is the golden goose. Why? Because the margins are way higher. So, why is this so critical right now? Well, because GE finds itself in what you could almost call a perfect storm of favorable conditions. For one, their biggest competitor is really stumbling with some engine problems, which obviously strengthens GE's position. Second, they're managing to move customers over to those super profitable T&M contracts much faster than anyone expected. And third, you've got this huge wave of service work coming in for their older but incredibly profitable CFM56 engines. I mean, these are some serious tailwinds pushing them forward. And this is where it gets really interesting. Look at this. Historically, the best margin GE's aerospace business ever hit was about 22%. Now, fast forward to today. The consensus on Wall Street for where those margins will be in 2030, you guessed it, about 22%. But other independent work suggests they could be looking at something more like 26, maybe even 28%. So it begs the question, right? With all these new advantages we just talked about, why on earth would we assume the future peak is just going to be the same as the past peak? It feels like the market is just anchored to old numbers. And that right there is the big takeaway. The market consensus seems to be stuck looking backwards, anchoring its expectations to a time that just doesn't exist anymore. What we're seeing looks like a structural shift in GE's profitability, and it's something that might not be fully priced into the stock yet. All right, let's pivot. We're going to shift gears from jet engines to data engines. Our second deep dive is on Moody's, and we're going to zero in on its incredibly powerful and I think often overlooked analytics business.
You know, you can't talk about a business built on data today without talking about AI. And for Moody's, this is the billion-dollar question. Is this new wave of generative AI a massive threat that's going to make their data worthless? Or is it actually the greatest opportunity they've ever had to become even more essential to their clients?
Well, to answer that, you have to understand what Moody's Analytics actually does. It's not just selling spreadsheets of data. We're talking about tools that are deeply embedded in how their clients operate. Things like CreditView for research, bank solutions that are literally part of the loan approval process, KYC tools for compliance, even solutions for insurers to model things like climate risk. This isn't just nice-to-have stuff. This is the essential plumbing of the financial system.
And that's the key word here, embedded. This isn't about an analyst logging into a website to look something up. This is about automated data feeds pouring directly into a bank's own internal systems. It's about Moody's data being the engine that powers the risk models for loan committees. It's what generates the reports they have to file with regulators. And now, with their AI tools, they're making it even easier for clients to get answers from all this proprietary data. Moody's is less of a vendor and more of a partner that's woven into the very fabric of their clients' workflow.
So what's the actual impact of all this AI stuff? Well, here's some real data. Turns out it's a huge value add. Analysts who use Moody's new AI-powered research assistant are saving between 25 and 30% of their time. I mean, think about that. That's a massive productivity boost, freeing them up from grunt work to do actual analysis.
But here's the part that I find fascinating, and it's a bit counterintuitive. You'd think if you make things more efficient, people would use it less, right? Nope. It's the opposite. The people using this AI assistant are actually on the platform about 60% more than those who aren't. So far from making Moody's obsolete, AI is making the platform stickier. It's driving engagement through the roof.
And this quote really says it all. The goal is to shift from just being a data provider to becoming an essential workflow partner. What does that really mean? It means using AI to become so indispensable, so woven into how your clients do business, that it reinforces your pricing power and makes you almost impossible to replace. That's the end game.
All right, one last point before we wrap up. I want to talk for just a minute about LVMH. Now, to be clear, we don't own it in the portfolio, but it's a fantastic case study for a concept that is absolutely central to our investment philosophy, understanding the nature of demand.
It really comes down to two different types of demand. On the one hand, you have cyclical demand, and LVMH is the poster child for this. It ebbs and flows with the economy. When times are good, spending on luxury goods goes through the roof. They over-earn. But when a recession hits, that spending disappears. It's volatile. On the other hand, you have what we call structural demand. Think about the data from Moody's. A bank needs that data whether the economy is booming or busting. It's non-discretionary. The revenue is stable, it's predictable, and it's recurring.
So I'll leave you with this question to think about. That cyclical boom can feel exciting, for sure. But our focus is always on finding businesses that are built on that durable structural demand. Because in a world that seems to get more volatile by the day, you have to ask yourself, which one of those provides a truly durable foundation for creating value over the long term? Thanks for joining me.